David, good morning. Good to see you again.
Carl, nice to see you.
Your notes so far this year have telegraphed the risks that you've talked about for a while. Rates, taxes even, margins, cost inflation. But you're holding on to 5,100, I think, for year end. Maybe you can talk a bit about what gets us there in the face of all those risks.
Sure, you are correct. We have a price target for the S&P 500 at the end of this year of 5,100. To put that in some context, that would be driven entirely by earnings growth of roughly 8%. Now, we anticipate that bond yields will also be rising to around 2% on 10-year Treasury yields at the end of this year, but that will be offset by a decline in the risk premium as we get beyond the midterm elections. We get beyond questions about some policy uncertainty with regards to taxes. We are not anticipating that there will be tax reform legislation. So as a result, Carl, it's really earnings that are likely to drive and lift the market higher. It has been an unbelievably busy start to this year. In fact, it's as busy as it was in March of 2000 in terms of the 2020, in terms of the number of incoming phone calls and focus, because you've had higher bond yields. You've had questions about the duration trade, if you will, and long-term growth, less profitable or low margin tech growth stocks. So it's lots and lots of focus. It's been very intense a couple of weeks right now. But the general trajectory of the equity market is moving higher.
So do you expect the overall aggregate conversation, once we start to move into earnings really tomorrow, to be one that is net comforting or net alarming?
It's an excellent question. I am focused very much on the margin profile for companies as we look into 2022. And Morgan just mentioned, the airline companies, as you pointed out, tomorrow you have the major financial institutions start to report, and that's always the early part of earnings season, and then it rolls through the rest of the market. And margins are such a critical part of the story because the economy, in our anticipation, is going to be decelerating in terms of growth. So it's not so much a top-line story, but rather can companies maintain their margins? And it is really a remarkable statement to think about. In 2021, last year, you had the Delta variant. You had all these supply chain disruptions. You had companies focusing on issues involving employee retention and attracting employees. You had commodity price spikes, all these issues, and companies still were able to raise margins to record high levels across pretty much the entire market. And I'm forecasting for this year that margins are also going to be increasing by a relatively modest amount, about 40 basis points. But that is a critical story behind how you get to a higher level of earnings. And that is ultimately what we're anticipating will take the market higher. So in the next several weeks, it will be less a focus for investors, in my opinion, on the idea of rates and the Fed policy and some of those changes, were much more micro, much more idiosyncratic focus on individual stock stories.